Welcome back. Module 11, derivatives, the zero sum game. So many people, they play in derivatives without understanding derivatives. That is the intent of this video. That's why we have put a series of video. Module 10, we have covered candlesticks. Now derivatives, the zero sum game. What is zero sum game? Before we go into that, our LinkedIn details, website, Twitter, YouTube details are all given. So in our YouTube, every day market positions we discuss, those are all given over there. Let's go into the action. Target audience, the same set of target audience, MBA, CA and CFA students. I'm not going to repeat it again. Other people are the same. Of course, the traders, intraday traders, definitely they should know. What is the takeaway? This is very important. Good understanding of derivatives. At the end of it, one will develop a good understanding of derivatives. Art of using derivatives in trading. Risk involved in derivatives. Many people trade without understanding the risk. One has to clearly understand the risk. Lastly, dramatic transformation in students, investor, traders, confidence level. Let's start. What is derivatives? Slide 4. Simple example. See, as I always tell, for understanding finance, all you require is simple English, common sense. Let us start with simple understanding. What is derivatives? Derived from something. Take a simple example. What is curd, butter, ghee, milk sweet? All are derived from milk. So, the quality of milk will determine the derivative product. So, this is a simple example of derivatives. Of course, we are not going to use all these things. This I want to make you comfortable. That's why I gave a very simple example of what a derivative means. Now let's go into derivatives from a financial term. Derivatives is a financial instrument whose value depends on the underlying variable. Very simple. If you understand this statement, you will understand that derivative is a contract and not an asset. What is the difference between a contract and an asset? An asset is something where it has perpetuity. What is perpetuity? That means the asset is there for perpetual period of time. Let's say for example a house. My father was having a house. So now I am owning the house. Now next my successors will own. Their successors will own the house. The house is there. The plot is there. The land is there. So the asset is there. The asset is for perpetuity. Equity stocks you take, right? In module 3, 2, 3, 4 and other things we discussed, right? Equity is a perpetual continuity, perpetuity, right? So perpetual means forever. It is perpetual. Whereas a contract means it is for a fixed time period. So that's the fundamental difference between an asset and a derivative. That's number one. Number 2 is derivative is a zero sum game. Zero sum game. What is that zero sum game? Simple. 11 minus 11 equal to 0. 547 minus 547 equal to 0. That means if I have won, somebody has lost. That's very simple. People play in India, the largest derivative market, option F&O market, futures and option, derivatives market in the world is India. Index, Nifty trading, Bank Nifty trading is the largest trading volumes. But people don't understand, most of them, I am not saying everyone, but I am saying large majority without understanding that derivatives is a zero sum game. That means if I win, somebody lose. If somebody wins, someone has lost. You might ask, no, equity does it not apply? It doesn't. I'll tell you a simple example. Let us say for example, somebody bought a share, let's say X company of share in 2004, it was quoting at 200 rupees. In 2015, it was 1000 rupees. The person has sold the share of company X at 1000 rupees, he exited. Suppose Z, an investor, has bought at 1000 and next 2 years it went down to 800. While the investor Z, he will have a notional loss, but ultimately he will be holding the shares. Now assuming that 2023 it is at 2000 rupees, he has made a profit. So then that means everybody, as long as the business is a good business, company is a good company, it's a going concern, it will make money and everyone in the value chain will make money. That means the train keeps on going, people will enter, exit, but everybody will make money. Possibility. But in a contract, that is not the case. If I make money, somebody loses, because it is for every trade there is a matching trade, and the contract has a time period, time bound within which the contract will be ended. Hence, it is a zero sum game. That's a fundamental two differences which one should understand before even thinking of investing in a derivative market. As you can see in the slide, derivative, there are three types of contracts: forwards, futures and options. Within options, we have two products: option to buy, which is called a call option; option to sell, which is called a put option, right? So this is what a simple understanding of derivatives will make you. Let's go to slide 6. What are the underlying assets? We saw derivatives are a financial instrument whose value depends on the underlying asset. What are the assets that can be? Any commodities. What are the commodities? Wheat, rice, tin, rubber, pepper, anything and everything, okay, that can be a commodity. Agriculture products, that's a big commodity markets in India. Then currencies, USD INR, Euro GBP, right, Euro USD, GBP USD, USD JPY, or any currency pairs that one can think of. So those are all derivatives, underlying assets. Equity, there are so many equity stocks in India that they are listed in the futures and options segment, F&O they call, right? So those equities, some of the examples are HDFC Bank, HDFC, ICICI, Reliance, many stocks. I am just giving some names as example. They are all, if you take the Nifty list, the stocks that are listed in F&O, they will be eligible for derivative. They are underlying asset. The stocks, the shares are underlying. Index, in India we have 3 index at least that are tradable at this point in time. We are in 2023 January. One is Nifty, second is Bank Nifty, third is Fin Nifty. These 3 are tradable in India. Others are measurable, but this is tradable. And lastly, any tradable commodity you can have derivatives. So derivatives is excellent. So what are the uses of derivatives? So now we are giving the basic examples. At this stage, let us look at the examples, but in the next modules we will see in extensively with examples. Then you will be able to easily appreciate each of the uses of derivatives. As you can see in slide 7, first is lock-in prices. So derivatives are typical what you call risk management tool available for locking in prices. What is it, lock-in prices? We will see in detail later on. Normally when, let's say, an exporter is going to receive dollars down the line, let's say 3 months down the line, so he can enter into a forward contract with a financial institution now to sell the dollars that he is going to receive from his global customer. That way he can sell the dollar 3 months down the line. He can agree to enter into a contract to sell the dollar 3 months down the line at an agreed price. So that way he can lock in the prices. Hedging, typically what happened, if you have stocks in your portfolio, you can use those stocks to sell in futures market. You can use covered strategy in futures, which we will be telling later. Basically you can hedge your position. Okay, you are having some stocks or in your asset which you can hedge to trade in derivatives market. We will see that example, then you will be able to appreciate these points. Mitigating risk, derivative, the fundamental idea is mitigate risk. Particularly a farmer, let us say for example a farmer wants to sell his produce, so he can mitigate his risk by entering into a forward contract which is called futures, and then mitigate any risk that might happen due to uneven price movement that might happen in the markets. That's an example. Arbitrage, arbitrage is nothing but taking advantage of two markets. Okay, typically if you see, let's say for example, if a trader, he buys and sells vegetables in large quantities, he can buy, assuming that he is accessible to two markets, nearby markets. He can buy in one market where the price is low and sell in another market where the price is high. That way he can take advantage of the price difference between these two markets, right, near his locality. That's a simple example I am giving for arbitrage. Speculation, speculation is something, is betting. People take most of the trades in India that is done on index options and equity options and futures are mostly speculative in nature. What it means, people take bets. That means they bet that the market will either go up or go down, and accordingly take derivative position as they want. But it is speculation. Unlike other what you call uses that I mentioned, this is more of a speculation and it is high risk. So these are the uses of derivatives. Some of the basic terms. Strike price. What is the strike price? Normally what happens in a derivatives contract, as I said, it is a contract. The strike price at which the contract, the buyer and seller agrees to enter the contract, that is called the strike price. Expiration date. As I said, it is a contract. The contract expires on a particular date. Hence, there is an expiry date. Okay, beyond which the contract is no more valid. Then there is lot size. This is very important. In equity shares also in India or globally there is a lot size. But equities, because of dematerialized form, demat form the shares are held, the lot size is 1. That means you want to buy any high price share also. Even if the share is quoting as 3,000, 4,000, you can buy one share. You can buy in multiples of 1, that is lot size. But in derivatives, there are certain minimum lot size that is given. Like for example, in India, in index, Nifty index, the lot size is 50. That means one lot you buy, you will have to buy 50 quantity. That means 2 lots you buy 100, 3 lots means 150 and so on and so forth. That is the lot size. That means the minimum value you can enter is 1 lot of 25. Okay. And contract value. What is contract value? Simple. The lot size into the market value. Say like for example, simple. In Nifty I told you one lot as of today, January 2023, one lot is 50. So let us say the Nifty price is 17,000, 18,000. Let's say for example, that means you want to enter one lot, whether buy or sell. Okay, the value is 18,000 into 50. So what it is? It is 9 lakhs. That is the contract value. So that's very simple, right? 18,000 into 50, 9 lakhs. That is the contract value. Option premium. This is particularly for applicable for options. We will talk of the various products, but it's applicable only for options where the buyer of the option will give premium to the seller of the option. I am sure you would have got a good understanding of basics of derivatives. We will see the forwards and futures and other things in the next modules. Thank you very much.